Good evening, dear traders. Today we will focus on US dollar against Japanese yen. So, after several weeks of gains, the US dollar continues to strengthen steadily against the Japanese yen. The primary driver remains unchanged: the persistent divergence in monetary policy between the United States and Japan. The US economy continues to show resilience, a strong labor market, ongoing inflation risks, and the Federal Reserve's caution stance have significantly reduced expectations for near-term interest rate cuts. This continues to provide solid support for the US dollar. The situation in Japan remains very different. Despite the Bank of Japan's gradual policy normalization, Japanese interest rates remain significantly lower than those in the United States. The wide yield differential carry trade between US and Japanese government bonds continues to favor the dollar, which has been the main reason behind sustained demand for US dollar against Japanese yen over the past several months. However, another important factor is beginning to attract increasing attention. The pair has once again moved well above the 160 level, an area that previously triggered currency interventions by Japanese authorities. In the past, Japan's Ministry of Finance repeatedly entered the foreign exchange market around these levels in an effort to slow the yen's rapid depreciation. While there has been no official confirmation that new intervention is being prepared, the higher US dollar against Japanese yen climbs, the more closely market participants monitor comments from both the Ministry of Finance and the Bank of Japan. In many cases, even strong verbal warnings from policymakers have been enough to trigger sharp corrections, so be careful. From a technical perspective, buyers remain firmly in control. The daily chart continues to display a sequence of high highs and high lows, while price remains comfortably above the major moving averages. As long as US dollar Japanese yen holds above the 160-161 area, the long-term uptrend remains intact. However, the pair is moving deeper into what many traders consider a potential intervention zone, meaning the risk of sudden and aggressive corrections is now considerably higher than it was just a few weeks ago.